You know, whenever traders ask me how to move from fumbling in the dark to operating with real clarity, I tell them it always comes down to levels. Levels of understanding, levels of control, and levels of self-command. And today we're going to talk about the 3 levels of trading mastery that separate the amateur from the operator. Before we dive in, let me tie this into the previous video on the 5-day trading tips, because everything we do in this game builds on the last lesson, just like price builds on previous swings. Most beginners think trading is about finding the right stock or catching some hidden signal. But the truth is far simpler and far harsher. Trading is about understanding yourself in the presence of opportunity. And let me ask you something. Have you ever seen a perfect setup, crystal clear, almost calling your name, and still managed to ruin it because you couldn't control your timing or your nerves? That's where the first level of mastery starts: observation. Not trading, not acting. Observation. When I first stood in those bucket shops as a kid, I learned more from watching the tape quietly than I ever did from taking positions too early. The market has a rhythm, a certain temperament, and it doesn't care about your hunger for action. If you can't sit and watch without letting your imagination run wild, how are you going to sit and trade with real money at stake? Many traders never make it past this level because they think patience is a form of weakness. But let me ask you, what's weaker than jumping at shadows because you don't know how to wait? At this first level, I didn't just watch prices. I watched myself. I studied what excited me, what scared me, what made me want to push buttons. You see, chart reading isn't just reading the chart, it's reading your reactions to the chart. That's the real education. Anyone can read a line. Few can read their own impulses. And that brings you to the second level of mastery: interpretation. This is where you stop seeing prices as just numbers and start seeing them as expressions of human nature. Fear, hope, greed, those things don't show up in textbooks. They show up in breakouts, pullbacks, failed rallies, and exhausted trends. If you've ever stared at a chart and felt that the move looked tired, you know what I'm talking about. The tape talks, as I used to say, but it doesn't speak English. It speaks behavior. Have you ever wondered why you can take the same setup on different days and get completely different results? Because the setup is only half the story. The market context, momentum, sentiment, volatility, that's what tells you whether the pattern has real weight behind it. Interpretation is knowing when the market is ready to move and when it's merely pretending. And plenty of traders misinterpret quietness as stability. Sometimes quietness is just the calm before your equity curve gets punched in the nose. And this ties back to that earlier video on the 5-day trading tips, where we talked about the importance of reading the broader environment before taking a single trade. What you learned there becomes twice as powerful when you understand how interpretation fits into the bigger picture of trading mastery. Tips become principles once you develop the eyes to see what the market is truly revealing. Now, the third level. This is the one most traders never reach, and it's not because it's complicated. It's because it requires discipline of a kind most people don't even practice outside their trading. It's the level of execution, not action. Anyone can act. Execution. Deliberate, planned, calm execution. At this level, you've already seen the trade, understood the trade, and now comes the hardest part, taking it the way you intended and holding it the way you intended. Execution is where your money mindset either saves you or buries you. Do you trade to make money, or do you trade to feel right? Do you cut losses because it's part of the plan, or because panic ran ahead of your reasoning? Be honest, how many times have you moved a stop because you didn't want to face being wrong? Execution is the level where the market tests your character. It asks whether you can follow your own rules when the pressure hits. And it's funny, many traders think the market beats them. But the market only reveals what was already inside them. If you're undisciplined in life, you'll be undisciplined in trades. If you chase thrills outside the market, you'll chase them in the market too. You can't escape yourself in this business. The market makes sure of that. Now, let me share something most traders, Never accept mastery isn't about predicting the future. It's about managing behavior, yours and the market's. The market tells you its behavior through price, volume, and velocity. You tell the market your behavior through your entries, exits, and risk. The game is a dialogue, and the skilled trader knows how to speak softly and clearly. Have you ever held a winning trade and still felt uneasy, as if the profit didn't feel real until you closed it? That's because execution isn't just mechanical. It's emotional architecture. It's the structure you build inside yourself to handle uncertainty without collapsing. A trader who can observe calmly, interpret correctly, and execute decisively is already ahead of 90% of the crowd. But you don't develop these levels by reading about them. You develop them by losing, learning, watching, and refining. The truth is, markets will always test your readiness. They don't care whether you slept well, whether you're confident, or whether you need the money. They only care whether you can respond to what's actually happening instead of what you wish were happening. And if you want to reach real mastery, you have to ask yourself at every stage, am I reacting or am I operating? Mastery begins with observing price without the urge to trade, and it sounds simple, almost too simple, but it's the foundation every serious operator must build on. Most people come into the market thinking their job is to act, to jump in, to do something. That urge to trade is baked into human nature, and that's exactly why it destroys most beginners long before they even understand what went wrong. The first task isn't to buy or sell. It's to study the market with enough patience and clarity that you can actually see what it's trying to tell you. Let me ask you something. When you look at a chart, are you really seeing what's happening, or are you seeing what you want to happen? When I started out, I didn't take trades because I was clever. I took trades because I was restless. I wanted action, and the market punished that restlessness every time. Eventually I learned what every successful trader learns. The price itself will tell you everything you need to know, but only if you stop trying to push your own expectations onto it. Observation is not passive. It's a skill. It's the discipline to watch the tape without needing to own it, to watch a trend without needing to be part of it, to see a swing without feeling the itch to grab a piece of it before you even understand what phase it's in. You can't get that kind of clarity if you're always thinking about entries. You can't hear the market's rhythm if your mind is already calculating how much you'd make. A trade worked out. Most beginners sabotage themselves because they watch charts the way gamblers watch spinning roulette wheels, hoping for a lucky number. But price action isn't luck. It's behavior. It's the collective outcome of millions of decisions happening across fear and greed. And have you ever noticed how different your judgment becomes the moment you feel money is at risk? That's why the first level of mastery demands that you watch without touching. When you observe the market properly, you start noticing details that most traders overlook. You begin to see how a trend breathes, how it expands, pauses, retraces, and resumes. You notice the difference between a pullback with strength behind it and a pullback that's actually a reversal in disguise. You see which moves have conviction and which ones are just noise shaking out the impatient crowd. These details aren't available to the trader who needs to trade. They're only available to the trader who is willing to sit, wait, and understand. It's like watching a skilled boxer. If you try to learn by jumping into the ring immediately, you'll get hit before you can even study the opponent's rhythm. But if you stand at the ropes and watch, really watch, you start seeing patterns. How the fighter shifts their weight, when they're strongest, when they're vulnerable. The market is no different. It has tells. It has patterns. But you only notice them when your mind isn't clouded with the urge to place a trade. And this level of observation isn't just about reading price movement. It's about reading yourself while you read price movement. What thoughts come up when you see a big green candle? Do you feel excitement? Urgency? Calm? What do you feel when you watch a slow, grinding trend? Boredom. Impatience. Those reactions are telling you just as much as the chart is. Because if you don't know how your own emotions behave during pure observation, How are you going to manage them when real capital is on the line? A trader who observes patiently begins to understand the difference between opportunity and temptation. Opportunity has structure. It forms slowly and clearly. Temptation jumps out quickly, loud and shiny, and disappears just as fast. When you observe long enough, you stop falling for every flashy move, because you've seen how often they fade. You wait for the market to show its hand instead of forcing it to reveal something that isn't there. Most traders lose because they want certainty, and they think certainty comes from acting quickly. But certainty, or at least the closest thing to certainty you'll ever get in this game, comes from observation, from collecting enough quiet data that you start recognizing the market's character. Have you ever noticed how, after watching the same stock for weeks, you start sensing its behavior instinctively? That's not intuition. It's familiarity built through patient observation. And the truth is, observation is the cheapest education you'll ever get. Every minute you spend watching without trading is a minute you're learning without paying tuition in losses. But people hate slow learning. They want action. They want results. They want excitement. And that's why the market takes their money, because they're trying to sprint in a business that rewards those who can stand still until the moment is right. The urge to trade is the greatest enemy of the early trader. It blinds you, rushes you, and convinces you that movement equals progress. But real progress comes from developing eyes that can spot genuine setups long before the average trader even realizes something is forming. Observation plants the seeds of mastery. It sharpens your judgment, strengthens your patience, and teaches you how to recognize order inside the chaos of price action. Only once you've mastered that can you move toward interpreting the market with the confidence of a real operator. Self-awareness develops alongside chart awareness, and this is where most traders completely misunderstand what real progress looks like. Everyone wants to read the market better, but very few want to read themselves with the same honesty. Yet the two are inseparable. You can't separate the trader from the trade. The decisions you make on a chart are born from the habits you've built inside your own mind. And let me ask you, how many times have you blamed the market for a loss when a deeper look would show the real problem was something you carried into the trade long before you ever clicked the button? Chart awareness is about understanding the flow of price, the behavior of trends, and the character of volatility. Self-awareness is about understanding the flow of your reactions, the behavior of your emotions, and the character of your impulses. When you improve one, the other improves with it. But if one is neglected, the other becomes distorted. If you read charts well, but know nothing about your emotional responses, your chart reading becomes unreliable the moment the market puts pressure on you. And if you know yourself well but can't interpret price action, you're fighting with half your tools missing. When I was young, long before I ever made a real fortune, I learned something important. The tape was never my enemy. My mind was. A chart doesn't care if you're overconfident, anxious, frustrated, or greedy. It doesn't adjust itself to your fears or your hopes. The tape just tells the truth. But your interpretation of the tape, now that depends entirely on who you are while you're looking at it. Have you ever noticed that the same chart looks different when you're calm versus when you're desperate to make back a loss? The chart didn't change. You did. That's why self-awareness matters. It acts like a filter between you and the market. A clear filter gives you clarity. A dirty one gives you distortion. And distortion is expensive. Most traders spend all day analyzing indicators, patterns, and timeframes. Rarely do they analyze themselves with the same rigor. They'll review every candle on a losing trade except the candle inside their own head, the thought that drove them into the mistake. Maybe it was impatience. Maybe it was fear of missing out. Maybe it was revenge trading. Maybe it was boredom disguised as opportunity. When you don't study these things, they repeat. And the market makes sure each repetition costs you a little more. Self-awareness also teaches you something vital. Every trader has personal strengths and personal weaknesses. And the goal isn't to eliminate them. It's to understand them. Maybe you're great at catching trends, but terrible at reversals. Maybe you're disciplined with stops but impulsive with entries. Maybe you thrive in fast markets but fall apart in slow ones. The sooner you identify these traits, the sooner you can adapt your style to fit the trader you actually are instead of the trader you wish you were. And let me ask you something else. Have you ever forced yourself into a strategy simply because it looked good on paper, even though it didn't suit your temperament? That's a lack of self-awareness. A strategy is only as good as your ability to execute it consistently. A method that conflicts with your natural rhythms will drain you, stress you, and eventually push you into mistakes. But one that aligns with your temperament will feel natural, steady, and sustainable. The more you observe charts, the more you begin to observe how charts make you feel. That connection becomes a powerful tool. For instance, you might start noticing that you tend to rush trades during the first few minutes of the session, or that large candles trigger excitement in you, or that pullbacks make you uneasy. These insights are gold because they allow you to anticipate your emotional tendencies before they sabotage your decisions. It's like knowing where the cracks are in a bridge. You don't wait for it to collapse, you reinforce it ahead of time. As chart awareness deepens, a trader learns to recognize signals not just in the price but in themselves. A sudden sense of urgency might mean the setup isn't actually as strong as it appears. A feeling of hesitation might indicate that your analysis is incomplete. A surge of confidence might confirm that the market is aligning with your plan, or it might be overconfidence trying to lure you into taking on too much size. Without self-awareness, you can't tell the difference. And when you combine both kinds of awareness, chart and self, you start seeing the market from a balanced perspective. The chart tells you what is happening. Your mind tells you why you want to act. When the what and the why align, you get clean, confident decisions. When they don't, you get conflict. And conflict leads to hesitation. Hesitation leads to inconsistency. And inconsistency leads to losses that never seem to make sense until you look inward. Self-awareness also helps you recognize your market identity. Are you a momentum trader, a swing trader, a trend follower, a breakout trader? This isn't something you guess. It's something you discover by watching how you behave in different environments. Some traders thrive when markets move sharply. Others excel when markets grind slowly. Some perform best when they have a few select setups. Others handle frequent trades well as long as they remain disciplined. Knowing yourself allows you to choose the style that brings out your strengths rather than exposing your weaknesses. And as you continue developing chart awareness, you also begin developing emotional literacy. You learn how various patterns affect your mindset. You learn how volatility tugs at your nerves. You learn exactly which conditions bring out your impatience or your caution. Over time, this sensitivity becomes a compass, guiding you away from dangerous decisions and toward choices that align with your trading plan. The truth is, chart reading doesn't happen in a vacuum. It happens through the eyes of a person with emotions, beliefs, biases, and tendencies. If you don't know that person, how can you trust the decisions they make in the market? The more honest you are with yourself, the more reliable your chart reading becomes, because you're no longer fighting hidden impulses while trying to read the tape. Interpretation turns raw price movement into meaningful behavior, and this is where a trader starts moving from merely seeing charts to actually understanding them. Anyone can look at a chart and point out a trend or a breakout. That's simple observation. But interpretation is different. It's the ability to look at price and recognize the intentions behind it. What the crowd is doing, what the professionals are doing, and how fear and greed are shaping every tick. And let me ask you something. When you look at a strong move, do you know whether it's real strength or just a burst of enthusiasm waiting to fade? Most traders think price is just numbers on a screen, but those numbers are the footprints of human behavior. Every rally is hope. Every sell-off is fear. Every long consolidation is uncertainty. Interpretation is the art of recognizing those emotions in the structure of the market, not in your own imagination. If you misread those signals, you misread the entire game. It's like trying to drive through fog. You think you see the road, but you're really guessing at shadows. When I was studying the tape, I began realizing that the price itself wasn't enough. I had to understand the character of the move. A rise in price meant nothing unless I understood how it rose. Was it steady and confident? Was it erratic and forced? Did volume confirm the move, or did the market seem reluctant? These questions are the building blocks of interpretation. A trader who ignores them ends up treating every move as if it carries the same weight. But some moves are genuine shifts in supply and demand, and others are just noise meant to shake you out or lure you in. Interpretation also means understanding how different phases of the market express themselves. A trending market behaves differently from a range-bound market. A euphoric market behaves differently from a fearful one. If you've ever traded a strong uptrend expecting it to behave like a sideways chop, you know how quickly the market teaches you the cost of misinterpretation. The chart isn't just lines, it's a language, and if you can't read it correctly, it doesn't matter how many indicators you add or how many strategies you memorize. What really separates a skilled trader from a struggling one is knowing how to weigh signals. For example, a breakout can look clean, but interpretation tells you whether the market is actually supporting the breakout or whether it's just trapping inexperienced traders. Have you ever seen a breakout that looked perfect? Clean line, strong candle, and then instantly reversed and left you wondering what happened? That's a lack of interpretation. The move looked right, but the underlying conditions weren't aligned. The crowd tends to focus on the obvious: big candles, clean levels, headlines, or momentum spikes. But interpretation goes deeper than that. It asks why now? Who is driving this move? Is it professionals accumulating quietly or amateurs chasing loudly? Is the market testing a level or rejecting it? Is volatility expanding or contracting? The tape gives clues, but it doesn't shout. You have to learn to hear the subtle changes. Interpretation also demands patience. You can't interpret anything if you rush. People see one strong bar and convince themselves they're seeing a trend. But anyone who understands the market knows that a single bar means nothing without context. A strong bar at the start of a move means something different than a strong bar at the end of a move. A pullback after a breakout means something different when volume rises versus when it dries up. The same pattern can have two completely different meanings, depending on what the market was doing leading up to it. Have you noticed how a setup that works beautifully in one environment fails miserably in another? Patterns don't work because they're patterns. They work because the psychological conditions behind them are aligned. And interpretation isn't just about reading the market, it's also about reading the reaction of the market to your expectations. Sometimes you expect a breakout, but instead the market hesitates. That hesitation is information. Sometimes you expect a fade, but the market holds firm. That firmness is information. Interpretation means paying attention to what the market doesn't do, not just what it does. Silence can be as revealing as noise. A lack of movement at a key level tells you just as much as a sudden impulse move. When you interpret well, you stop forcing the market to fit your biases. You start letting the market tell its story. A trader who interprets properly doesn't get fooled by every sharp candle or every dramatic move. They wait to see whether the behavior matches the logic of the pattern. And when it doesn't, they step aside calmly. No frustration, no confusion, no guessing. Interpretation strips away the drama and reveals the intention beneath the surface. Another part of interpretation is recognizing transitions, those subtle moments when the market shifts tone. A trending market starts losing momentum. A range market starts tightening. A quiet market starts stirring. These shifts often show up long before the actual move happens, but only if you're sensitive to the behavior. Most traders miss them because they're too focused on the obvious signals. But by the time the obvious appears, the professionals have already positioned themselves. Interpretation lets you see the footprints before the crowd arrives. And if you think about it, the greatest trades you'll ever take come from interpreting the market's behavior accurately, not from blindly applying a strategy. The market rewards traders who understand what's happening beneath the surface who see the psychology unfolding through price movement, and who respond to behavior rather than reacting to noise. That's why interpretation is the bridge between watching the market and trading it with conviction. Market context outweighs individual setups, and this is one of the hardest truths for traders to accept. Everyone wants a clean pattern, a perfect signal, a tidy little formation that promises a high probability entry. But the market doesn't reward patterns, it rewards understanding. A setup only matters when the environment around it supports the move. Without context, even the prettiest chart formation is nothing more than a trap waiting to spring. And let me ask you something. How many times have you taken a perfect setup in the wrong market conditions and wondered why it failed instantly? Most traders treat setups like sacred formulas. They memorize breakouts, pullbacks, reversal structures, but they ignore the other half of the picture, the climate in which those patterns appear. Think of it like planting a seed. You can have the best seed in the world, but if you plant it in the wrong season, the wrong soil, the wrong weather, nothing will grow. The same goes for trading. A high-quality setup planted in the wrong market environment has almost no chance of succeeding. When I studied the tape, I learned that markets have moods. Sometimes they're eager and impulsive. Sometimes they're sluggish and cautious. Sometimes they're balanced and waiting. You can see those moods in the speed of price movement, the depth of pullbacks, the strength of rallies, and the consistency of volume. If you ignore those moods and focus only on patterns, you're trading blind. You might think you're choosing good trades, but really, you're choosing isolated shapes with no understanding of the environment surrounding them. Context tells you whether the market is rewarding breakouts or punishing them. It tells you whether trends are carrying cleanly or stalling constantly. It tells you whether reversals have force behind them or if they're just brief pauses in a larger trend. Without this understanding, you end up treating all setups as equal, when in reality some are strong, some are weak, and some are downright dangerous depending on the conditions. Have you ever noticed that during certain phases of the market, every breakout seems to work beautifully? Price pushes through levels cleanly, momentum follows, and the trade moves smoothly. Then, at other times, those same breakouts fail instantly, trapping the trader and reversing harder than before. The setup didn't change. The context did. That's why experienced traders often say, the market decides the edge, not the pattern. A pattern is just a shape. Context is the environment that gives that shape meaning. When the environment is supportive, even mediocre setups have a chance. When the environment is hostile, even the best setups crumble. Another part of context is understanding where you are within the larger structure. A breakout at the beginning of a trend is not the same as a breakout at the end of a trend. A pullback during momentum is not the same as a pullback after exhaustion. A reversal pattern in the middle of a range is not the same as a reversal pattern at the edge of a major level. Traders who skip this deeper layer of analysis end up getting stuck in low-quality trades without realizing why. Context also includes broader market conditions. If the overall index is weak, even strong individual names can struggle. If the market is volatile, tight setups might get whipped out. If the market is quiet, large breakout candles might simply fade because there isn't enough energy behind the move. A trader who ignores these factors ends up fighting against the tide. And you can fight the tide for a while, but eventually it wears you down. Let me ask you something else. When you see a pattern forming, do you ever stop and ask whether the market is in the right state to support that pattern? Or do you get so focused on the structure that you forget to look at the bigger picture? This is where many traders go wrong. They fall in love with the setup and forget about the environment. Context also shows up in the way price reacts to important levels. If the market approaches a level slowly and hesitantly, that tells you something. If it approaches aggressively with building energy, that tells you something else. The setup may be the same, but the behavior leading into it changes the entire probability of the trade. Most traders don't look closely enough at these nuances because they're too busy searching for the next recognizable pattern. Another subtle part of context is understanding crowd psychology. When the crowd is fearful, setups behave differently. When the crowd is greedy, the market behaves differently. You can see this in the velocity of moves, the sharpness of reversals, and the conviction behind rallies. A trader who learns to read this psychological environment gains an advantage that no indicator can replicate. This is why some traders seem to feel the market, even though they're not relying on intuition alone. They're reading context. They're seeing the broader environment that gives meaning to each move. They're observing whether the market is expanding or contracting, whether participants are committing or hesitating, whether moves are being absorbed or extended. That kind of awareness turns a basic setup into a calculated decision rather than a gamble. When you understand context deeply, trading becomes less about predicting and more about aligning. You're not trying to force the market to do something. You're simply positioning yourself when the environment supports the trade and stepping aside when it doesn't. A disciplined trader uses setups like tools but uses context like a compass. Without the compass, the tools are useless.